For years, the story seemed pretty straightforward. Bitcoin was the new gold, right? The digital heir to the throne of hard money. But what if that story just hit a massive, unexpected plot twist? Today, we are diving into this fascinating split where old-school gold is absolutely surging while Bitcoin is, well, kind of stalled. And we're going to look at one pretty wild theory about what this could all mean for Bitcoin's future price. Let's break it all down.
For the longest time, it felt like a one-way street. The scoreboard was clear. One Bitcoin bought you more and more and more gold. It just seemed inevitable. But over the last few months, that scoreboard has been completely flipped on its head. Gold is smashing all-time highs, while Bitcoin seems to be stuck in the mud.
And the difference is just stark. You've got gold on one side, pushing into record territory, flirting with $4,900 an ounce, and on the other side, you have Bitcoin, just sort of trapped, hovering around that $89,800 mark. This growing gap is exactly what we need to unpack.
So, you have to ask the question, what on earth happened to the digital gold story? The whole idea that drove so much of Bitcoin's rise is now being challenged in real time by the OG, its oldest predecessor. And to figure this out, we need to look at one single really crucial number.
See, to really understand what's going on, we can't just look at the dollar price of each one. That doesn't tell the whole story. We have to look at the relationship between them. And one specific ratio is telling a very, very unusual story right now.
That clue is the Bitcoin to gold ratio. It sounds technical, but it's actually super simple. You just take Bitcoin's price and you divide it by the price of 1 ounce of gold. The number you get tells you exactly how many ounces of gold a single Bitcoin can buy. You should really think of it as the direct scoreboard in this match between old money and new money.
Now here's where it gets interesting. If you look at its history, Bitcoin's value relative to gold has followed this pretty predictable upward path. But lately, that has changed dramatically. The ratio has basically fallen off a cliff, dropping through what some analysts are calling a trapdoor, and it's now way, way below where these models predicted it would be.
And here is where we are today. Right now, 1 Bitcoin buys you about 18.5 ounces of gold. Now, this number represents a massive underperformance compared to where the historical trend suggested it should be. And this huge deviation is the entire setup for a very dramatic theory.
So, what happens when a price gets this far away from its historical average? Well, this is where things get really wild. It brings us to a potential revelation, the predicted snapback. Some folks believe this isn't the end of the digital gold story at all, but actually the prelude to a massive, massive price correction.
The whole idea is based on this classic financial concept called mean reversion. The theory itself is pretty simple. When an asset's price, or in this case a price ratio, stretches way too far in one direction away from its historical average, it tends to snap back, and often violently, kind of like a rubber band.
This table right here, this translates that theory into cold, hard numbers. So let's just use a gold price of $4,900. Today's ratio of 18.5 gives us Bitcoin's current price, around 90,000 bucks. But just watch what happens if that ratio snaps back to its historical average of 35. Bitcoin's implied price suddenly jumps to over $171,000. And if it overshoots to the upper band, now you're looking at nearly $300,000.
And here it is. This is the headline number. If you combine a strong snapback in that ratio with Goldman Sachs' forecast for gold to hit $5,400 an ounce, well, the math gets even crazier. The implied price for Bitcoin? $324,000. The theory is that gold's strength is stretching that rubber band so far that the snapback for Bitcoin could be absolutely epic.
Okay, but before we all get carried away, we need to take a deep breath and have a serious reality check here. Because models are clean and neat, but markets are messy, and there are some powerful fundamental reasons why this time really could be different and why a snapback isn't a sure thing.
It is so important to remember this. A model can be a useful guide, but it is not a map to the future. Historical trends are not physical laws, and there are some very powerful real-world forces at play that could be rewriting the rules entirely. So first, let's look at gold. This isn't just some random price spike. You've got central banks buying it up, you've got major players like Goldman Sachs raising their price targets, and maybe most telling of all, gold is rallying even with high real yields, which normally should push its price down. All of this points to some deep, structural demand for gold as a true safe haven asset amid all this market stress and geopolitical tension.
And then you have Bitcoin, which is facing its own set of headwinds. We've seen some pretty significant outflows from the US spot Bitcoin ETFs. We're talking over $2.5 billion recently. The big institutional buyer has been, well, fickle. So right now the market seems to be stuck, just waiting for a new catalyst to break out of this holding pattern.
So where does all of this leave us? It's become this incredibly fascinating fight for the hard asset crown. And instead of just guessing what happens next, there are a few key signals you can actually watch to see which narrative starts winning out.
So here are 3 things to keep your eye on. First, gold's resilience. Does it hold its price up here even if real yields stay firm? Because that would point to real structural demand. Second, the ETF flows. Do those recent outflows from Bitcoin ETFs finally stop and start to reverse? And third, the breakout. Does Bitcoin finally and decisively move out of its current holding pattern?
Ultimately, this Bitcoin to gold ratio is forcing us to stop just staring at one price and start asking a much bigger question. In a world full of uncertainty, which asset is truly winning the fight to be the ultimate store of value? Right now, the answer isn't nearly as clear as it used to be.